Lloyds Banking Group has just supplied an awkward update for its own business. UK house prices were broadly flat in July, rising only 0.1% over the year, while mortgage rates remained volatile. My provisional reading is that this is not yet a credit shock. It is a warning that the same rate environment supporting Lloyd's margin story may be weakening mortgage demand and household confidence. The evidence does not yet show which effect is larger in Lloyd's accounts. The bullish interpretation had been straightforward. Recent coverage pointed to Lloyd's shares rising sharply, with higher interest rates lifting net interest margins, while the absence of a housing crash kept bad debts contained. Its recent results were described as showing income up 10%, net interest margin rising from 3.04% to 3.22%, a 30% increase in the interim dividend, and a new £1 billion buyback. On that reading, Lloyds was converting a difficult economy into shareholder returns.
That matters because a bank can benefit from higher rates in one part of its income statement while losing opportunities elsewhere. Higher rates may improve the spread between loans and deposits, but they also raise the monthly cost of a mortgage. If fewer households move, buy, or refinance, lending growth can slow. That is an inference from the transmission mechanism, not a figure established by these articles. None of the usable reports quantifies the effect on Lloyd's own mortgage applications, balances, or future impairments. The mortgage market also shows why there is no simple rates are falling or rates are rising answer. Moneyfacts reported average 2- and 5-year fixed rates falling month-on-month to 4.86% and 4.91%, with product choice close to a record and more deals available to borrowers with smaller deposits. Yet Lloyd's housing report cited recent 2- and 5-year rates above 5.6% after a rise linked to inflation fears and Middle East tensions. The difference may reflect timing, product mix, and repricing speed. For a borrower, those details are the market. Lenders are responding according to their own funding costs, margins, and application pipelines. Nationwide cut selected rates after swap rates fell. Halifax then raised some rates despite those cuts, with brokers suggesting it was managing a surge of applications or protecting profitability. NatWest announced reductions across more than 200 products, while some existing customer rates were moving in the other direction. Competition can therefore pass lower funding costs to borrowers, but it can also prevent Lloyds from capturing every benefit of a higher rate environment. There is a second reading here. Flat prices are not the same as a falling housing market. Northern Ireland and Scotland continued to record annual growth, while the Southeast and Greater London weakened. Wage growth and greater mortgage product availability may be cushioning demand, and Lloyds itself expects activity and prices to remain broadly stable for the rest of the year. That limits the case for treating this report as an immediate bad debt warning.
For a holder, the point to reconsider is the quality of the earnings tailwind. The dividend and buyback case is supported by recent profitability and capital generation, but it is also exposed to how long Lloyds can preserve margins while keeping mortgage lending competitive. For a watcher, a flat house price index should not be read as a verdict on the shares. The more useful evidence will be whether mortgage rates and household confidence stabilize without lending activity fading. The strongest current judgment is therefore conditional. Lloyds is not facing a demonstrated housing collapse, but the easy version of its higher rate story has become less convincing. The next checkpoint is the one Lloyds itself identifies, whether mortgage rates respond favorably to the inflation outlook, and whether household confidence translates into activity. The available bodies do not establish how that balance will affect Lloyds' revenue, margin, or credit losses.